A recent landmark ruling has sent a clear message to all Kenyan businesses. The Tax Appeal Tribunal has upheld KRA's power to treat all unexplained bank deposits as taxable income. This isn't just a legal case, it's a critical warning. If you can't prove that a deposit isn't income, then KRA is legally entitled to tax it. The case began with KRA investigating Kirin Pipes tax affairs from 2019 to 2022. They obtained the company's bank statements and compared the total deposits to the revenue declared in the tax returns. A significant variance was discovered, which KRA then treated as undeclared income. An assessment of over 56 million was issued, and when Kirin Pipes objected, the KRA reduced the amount but still upheld a 21.6 million shillings liability. The tribunal's decision was based on a key legal principle. Section 56 of the Tax Procedures Act places the burden of proof squarely on the taxpayer. This means it is not KRA's job to prove that a deposit is income. It is the taxpayer's job to prove it is not. Without supporting documents, your claims are considered mere avertments and will be rejected. KRA recognizes that not all deposits are income. For example, loans from a bank or a supplier are not taxable. Neither are capital injections from shareholders to the business. Even simple inter-account transfers between your own business accounts must be documented. Kirin Pipes failed precisely because they couldn't provide sufficient proof for these types of deposits. Don't wait for a KRA query. Take action now to protect your business. First, immediately reconcile all your company bank accounts for the past 5 years. For every single deposit that isn't a sale, you must find and secure the supporting documents. For example, find a signed loan agreement for any loan or a shareholder resolution for any capital injection. The goal is to have a clear, verifiable paper trail for every single shilling. Beyond fixing past issues, the key is prevention. You need to implement strict internal controls to avoid these problems in the first place. This includes separating your business accounts from personal funds and creating a formal policy that no money is deposited without a clear, documented purpose. Remember, a robust, verifiable document trail is your best defense against a KRA assessment. When KRA comes knocking, you must be ready with specific documents. For sales revenue, you need invoices, ETR slips, and delivery notes. For loans, you'll need the signed loan agreements and board resolutions. And for capital injections, you'll need the shareholder resolutions and updated company records. Using this simple checklist can save you from a massive tax bill. The cost of non-compliance is far more than just the original tax bill. First, KRA can use an arbitrary, inflated assessment based on their best judgment. On top of that, you face severe penalties and interest on the unpaid tax, which can double or even triple the amount. And finally, challenging a wrongful assessment is a costly and time-consuming process with the risk of criminal exposure for providing false information. To wrap up, here are the 3 key takeaways from the Kirin Pipes ruling. 1. Bank deposits are now considered prima facie evidence of income. The burden of proof is on you. 2. A strong objection requires verifiable, credible evidence. And 3. The best defense is proactive financial hygiene and meticulous record keeping. Don't wait, review your records today and ensure you are protected.